Imagine owning a piece of the company building the operating system of the modern war machine and the AI brain of half the Fortune 500 at 33% off. Palantir Technologies. 2.4 billion shares outstanding. 341 billion in market cap. 8 billion in cash. Zero debt. And a stock that has just fallen from $207 down to $138. But here is the catch. This same company trades at a price-to-earnings ratio of 160, 70 times revenue, 40 times book value. Is this the AI infrastructure gold mine of the decade, or the most expensive trap in software? In this video, I'm walking you through every single number, the bull case, the bear case, the competition, and where I think this stock is really heading. This is long-term yield. Welcome back to the channel. If you're new here, I do one deep dive per week on a stock worth holding for 10 years or more. Let's get into Palantir. Palantir was founded in 2003 in the shadow of the September 11th attacks. The original mission was simple: help the United States intelligence community find terrorists by connecting the dots across data that had been hopelessly siloed. The 5 co-founders included Alex Karp, Peter Thiel, and Stephen Cohen. Today, Palantir builds 3 flagship platforms: Gotham, the defense and intelligence platform; Foundry, the commercial operating system for global enterprises; and AIP, the artificial intelligence platform, which sits on top of both and turns large language models into operational decision-making agents. And the secret weapon nobody talks about: the forward-deployed engineer. Palantir embeds its own engineers inside customer organizations to build something called an ontology, a custom data model of how that organization actually runs. Once your company's entire operational workflow is mapped into Palantir's ontology, ripping it out costs years. Roughly 55% of Palantir's revenue comes from government contracts, 45% from commercial enterprises, but the commercial half is growing faster, and that mix is shifting every quarter. Now, let's talk about the financials, because this is where the Palantir story gets genuinely impressive, and where the bull case really starts to crystallize. Revenue. Trailing 12 months. $5.22 billion. 5 years ago, that number was $1.09 billion. That's a 5-year compound annual growth rate of 32.58%. And here is the kicker. The 1-year growth rate is 67.71%. The growth is accelerating, not slowing down. Look at what happened to operating margins. In 2020, Palantir's operating margin was negative 107%. Today, it's positive 38%. A swing of 145 percentage points in 5 years. This is one of the most dramatic margin transformations in modern software history. Net income for the trailing 12 months. $2.28 billion. Up 287% year over year. Free cash flow. $2.69 billion. Free cash flow margin, 51%. For every dollar of revenue, Palantir is keeping 51 cents in cash. Return on invested capital, 31.94%. Return on equity, 32.89%. Gross margin, 84%. These are not normal numbers. These are elite software numbers. And they tell you that once Palantir lands a customer, the unit economics are extraordinary. And the balance sheet. This is where it gets really interesting. $8.04 billion in cash and short-term investments. Total debt, 0. Let me say that again. 0 debt. Palantir has more cash than the entire market cap of many S&P 500 companies, and not a single dollar of borrowings against it. Cash equals optionality. Palantir could spend $1 billion on a strategic acquisition tomorrow. They could buy back 6% of their own float. They could fund 5 years of R&D out of pocket. In a downturn, they don't need anyone's permission. That is rare in software. There is one number every software investor needs to know about Palantir: the Rule of 40 score. Most analysts consider a healthy SaaS company anything above 40. That's growth plus profit margin. Palantir's Rule of 40 score is 127%. Top decile of the entire software universe. And the recent quarter, Q1 of 2026. EPS came in at 33 cents. Wall Street expected 28. Revenue, $1.63 billion. Expected 1.54. That is the 24th straight quarter Palantir has beaten earnings estimates. 24 for 24. 6 straight years of beating expectations. So why is this stock down 33% from its highs? Time to talk about the bull case versus the bear case, because both are real. The bull case in 4 parts. Number 1, Palantir is becoming AI infrastructure, the logic layer of every enterprise that wants to deploy artificial intelligence to operations. The Rule of 40 score of 127% isn't a fluke. It is structural. Number 2, defense entrenchment. The Maven Smart System was officially designated a program of record by the U.S. Department of Defense. That means institutionalized, long-term funding. The Army consolidated 75 separate contracts into a single 10-year agreement worth up to $10 billion. That alone could contribute over $1 billion in annual revenue. Number 3, commercial momentum is on fire. U.S. commercial revenue grew 137% year-over-year in the most recent quarter. Net dollar retention, 139%. That means existing customers are spending 39% more every year. That is a top decile software metric. Number 4, the partnerships are stacking up. Bain & Company for global enterprise deployments, Google Cloud Marketplace with two-way Foundry and BigQuery integration, L3 Harris for defense manufacturing, McCarthy for construction, GNP Seguros for insurance. The platform is going horizontal. That is the bull case. Now, let's talk about the part the market is actually scared about. The bear case has 3 brutal points. Point number 1, the valuation. Price to earnings, 160. Price to sales, 70. Price to book, 40. Even after a 33% drop, this is one of the most expensive stocks in the entire software universe. Let me put this in perspective. Microsoft trades at a price-to-sales ratio of 10. Oracle, 10.7. ServiceNow, 8.9. Palantir trades at almost 70. You are paying 7 times the multiple that the rest of the enterprise software universe trades at, and the market has zero patience for any growth disappointment at these levels. Point number 2, stock-based compensation. This is the part most retail investors miss. Palantir paid $730 million in stock-based compensation over the last 12 months. That is roughly 14% of revenue. Shares outstanding have grown from 1.7 billion in 2018 to 2.57 billion today. That is a 49% dilution in 7 years. If you back out stock-based compensation from net income, which I think you should, the real earnings power is closer to 1.55 billion, which means the effective price-to-earnings ratio of Palantir is closer to 220. Not 160. That is the real cost of the dilution. Point number 3, the hyperscaler threat. Amazon Web Services, Microsoft Azure, Google Cloud, Snowflake, Databricks. Every one of these is building modular AI infrastructure at lower cost. If enterprises choose flexible, best-of-breed solutions over Palantir's integrated stack, the moat shrinks. The recent Google Cloud Marketplace deal is, frankly, an acknowledgement that interoperability matters. Now, competitive landscape. Who does Palantir actually compete with? In commercial, Microsoft Fabric, AWS, Google Cloud, Snowflake, Databricks. In government, legacy defense contractors like Booz Allen, Leidos, and CACI that are pivoting to software. And in defense innovation, Anduril, the venture-backed disruptor that is genuinely threatening. Here's the thing. Palantir's gross margin of 84% and operating margin of 38% are elite, higher than most pure software companies, which means the unit economics, once a customer is landed, are exceptional. The question is not whether Palantir is a good business. It is whether it is a 160 PE good business. All right, let's talk valuation. The current price-to-earnings ratio is 160. The forward price to earnings, based on next year's projected EPS of $2.08, is 68. That is a meaningful discount, but still well above the average software multiple of 25. Let's run the math. Bear case, apply a 30 times sales multiple to Palantir's projected revenue. Fair value around $86. That is 38% below today. Bull case, apply a 90 times sales multiple. Fair value around $260. That is 88% above today. The central case lands roughly where we are now, about $144. Now let's look at the chart. Here's Palantir over the last 12 months with the 50, 100, and 200-day moving averages overlaid. Price is currently $138. The 50-day sits at $141. The 100-day at $146. The 200-day at $161. Price is below all three. Technically, short-term bearish. But here is the historical pattern. Look at the long-term chart. Every time Palantir has traded this far below its 200-day moving average, it has been an accumulation zone. Following the November 2023 dip, the stock tripled within 15 months. The market has consistently underestimated how fast this business compounds. So, what's the verdict? Here's my framework. The bull case is that you are buying a zero-debt, $8 billion cash, hyper-growing AI infrastructure compounder with a wide moat in defense and 139% net dollar retention in commercial, on sale at a 33% discount to its highs. The bear case is that you are buying a 160 PE, 70 times sales, dilution-funded software story whose entire return profile depends on perfectly executing AI infrastructure dominance over the next decade. Both can be true at the same time. That is what makes Palantir the most interesting stock in the market right now. My buy zones. And this is not financial advice. This is just how I personally think about position sizing for a high-volatility name like this. Aggressive accumulation between $130 and $145, right where we are now. Heavy buy zone between $115 and $125. If it retests the 52-week low, and I would wait or trim above $200. And one last thing, position sizing. For a name with a beta of 1.52 and a price to sales of 70, Palantir should be a 2 to 5% position, not a 10 or 20% position. The asymmetric upside is real, but so is the asymmetric downside. Size accordingly. If you found this Palantir deep dive useful, hit that subscribe button. It costs you nothing and helps me make more videos like this. Drop a comment with the next stock you want me to break down. And remember, this is not financial advice. Do your own research and never invest more than you can afford to hold for 10 years. I'll see you in the next one.